Does refinancing my mortgage affect my taxes? Have you ever wondered how refinancing your mortgage might impact your taxes? This is a common question for homeowners and real estate investors alike. When you refinance, you are essentially taking out a new loan to pay off your existing mortgage. The tax rules that applied to your original mortgage generally carry over to this new loan. Let's break down the key points you need to know. First, let's talk about the mortgage interest deduction. The interest you pay on your refinanced mortgage is usually tax deductible if you itemize deductions on your federal tax return. For primary residences, the Internal Revenue Service allows you to deduct interest on loans up to $750,000 if you are married and filing jointly. If you are married and filing separately, that limit is $375,000. This limit applies to the total amount of your original mortgage and any refinanced loan. If you own rental properties, the interest on your refinanced loan can be deducted against your rental income, which helps lower your taxable rental profits. Next, let's discuss points paid during refinancing. Points are fees that you pay to reduce your mortgage interest rate. When you refinance, these points may be deductible, but typically, you will need to amortize them over the life of the loan instead of deducting them all at once. However, if you are refinancing a rental property, you may be able to deduct points and closing costs against your rental income right away. Now, what about cash-out refinancing? If you choose this option, the cash you receive is not considered taxable income because it is a loan. However, to deduct the interest on the cash-out portion, you must use the funds for capital improvements on the property. Capital improvements are expenses that increase the value of your property or extend its life. If you use cash-out funds for personal expenses, that portion of the interest will not be deductible. It is also important to note that most closing costs and fees associated with refinancing are not deductible as expenses. However, some of these costs can be added to the cost basis of the property or amortized over time. For real estate investors, refinancing can provide significant tax benefits. By allowing you to deduct mortgage interest, points, and certain closing costs against rental income, refinancing can improve your cash flow and reduce your taxable income. It is essential to keep track of how you use cash-out refinance proceeds to ensure you maximize your deductions and comply with Internal Revenue Service rules. In summary, refinancing your mortgage can indeed affect your taxes, primarily through mortgage interest deductions and the treatment of points and fees. Understanding these aspects can help you make informed decisions about your real estate investments.